Good morning, ladies and gentlemen. Well, it was a very quiet week. Risk dial unchanged at 93. I don't expect that to last this week. This is going to be a very different week. As you can see, we basically didn't move more than 20 points in the S&Ps all week or in the bonds, and the differentials stay very much unchanged. But I don't think this is going to happen this week for the reasons that I will now enunciate, and I will give you my expectations for what happens during the Treasury's quarterly refunding announcement, which I think is going to be very, very important for these markets going forward. As I said, this was a very quiet week and not a lot happened neither to the yield curve nor to outright prices in the bonds, but I think this is going to be very, very different this week. We will touch one extreme or the other, I think, depending on the quarterly refunding announcement, simply because the possibility for a very big surprise is there. And in that case, this is the prep work that we're doing for the Wednesday announcement, because prices on Thursday, I think, are going to be completely different from what they are now in terms of both yield curve and, of course, outright bond yields, and spreads between Europe and the United States. So we have to know what prices we want to trade and which direction we want to trade in according to the magnitude of the announcement. Twos, tens, I think this is probably the one that's going to react quite a lot, because the twos aren't going to move, but the tens could move significantly. If the announcement, as I expect, is a lot more bearish for bond prices, we could easily go and retest in one day this 159, 160 basis point level. Do not be surprised at all if the move is of that magnitude in a day on the 2s, 10s. The other parts of the yield curve, like the 5s, 30s or the 10s, 30s, were also very quiet last week, as you'd expect. But the likelihood is that we go and retest. If I'm correct, we will retest the 154 level, but I'm prepared for both ways. I think we've spent long enough here to get an extension now, either down to 154 or up to 124 basis points. I don't think, if the refunding is really, really good, I don't think this 140 level holds it. But on the other hand, I'm not expecting it to go that way. I'm expecting it to come down towards 154. And if we look at the 10s, 30s, this is going to be a tougher one. This is the one that I'd leave alone, because I think while the general trend will be towards a steepening of the yield curve, if I'm correct, and the refunding is far worse than people expect, the 10s, 30s could go either way, because if people don't really see that as being inflationary, it could be just 10s that get it in the neck and 30s stay relatively stable, in which case we test this 64 level. But it could be a general panic, and in which case we go down towards the 80 basis points. But this is the one that I would leave alone. And really, I would trade 2s, 10s rather than anything else. And we have our levels and we are prepared. On to the outright prices and rather yields of the different tenures of the yield curve in the States. I mean, I was right. We did not break last week lower. We broke higher. And the very fact that we are breaking higher tells me that we are unlikely really to close below 79 to 80 basis points in the 5 years for a long time to come. I think all the pressure is going to be up towards the ultimate target of 117 basis points. I just can't see people being enamored with the belly of the curve, whatever the announcement is. I think the 2s and 5s are going to move least, but all the action is going to be in the 10s, I would have thought, and possibly less in the 30s. We turn back up. I'll enlarge this so you can see. It felt all week like we were offered in the 10-year note. We got to 169 basis point, touched it, basically just retraced a little bit to catch our breath. But I think the path of least resistance is to go up and actually break these lows and go up towards 185 basis points. If the refunding announcement is bad, I think people are going to jump all over the 10-year and take it up towards 185 to possibly even higher over the next couple of weeks and months. But I'm just saying, if the refunding announcement is as large as I expect it to be, really don't look for technicals to hold it, like Bollinger Bands, RSIs, all rubbish. I think first stop, within a couple of days is 185 basis points. It's going to be that sharp. As I said earlier, I'm very much in two minds as to what the 30s will do, and I would leave them alone. Refunding pressure is one thing, and inflation expectations in the very long term are something completely different. The first reaction, if I'm correct, will definitely be up. But, when things settle down, I think it's quite possible that we retest the low, but that we hold levels around 135, 136 in the TLT, and yield levels around this, 240 basis points, that we just don't go much higher than that, which flattens the 10s, 30s portion. And that's why I said actually leave the 10s, 30s alone, because that's a really hard one to gauge what will happen to it. 2s, 10s, I think, is going to get massacred. 5s, 30s is probably going to go a little bit steeper, but really the one 10-year that will suffer should be the 10 years and just do not be long of 10 years. 30 years could be, something like this, 200-300 points down in TLT, then dicks around and then does nothing much. So really, what you really want to hit is the 10s. In Europe, things are not all that different from the United States. I've been saying that that the yield curve is going to steepen, and that yields are going to go higher. This is now the bubble. As you can see, we've gone high in yield basically all week, and I still expect it to get to minus 51, minus 52 over the course of the next few days, stroke weeks. I think the trend is now pretty much set. So if we look at the 10-year, you can see that we got to my minus 22, which was confirmation, and now we need to break this minus 17 area to give us impulsion back up towards, positive territory. I don't think there's going to be much between here and there. And that's a big move. That's like a 19 basis point move. It's going to be quick. And that is what gives me the clue that quite possibly we will have a bad refunding from the States, which actually accelerates everything. Now, the ECB is reminding me of the little Dutch boy with a finger in the dam, because they're supporting, one day they're supporting bunds, the next day they're supporting OATs, the third day they're supporting bonos, and then they're supporting BTPs. But in the meantime, since they can't support everything, one bond goes and then the others catch up eventually. And I will show you that today. They are very active in the market, and they're countering this, but I think the trend that the market wants to take yields higher is now unmistakable. Not much has happened in the bunds yet. It's going 1, 2, 3, 4, 5, 6 basis points, in a week, but nothing much is really happening. If we have a look at now at Italy, you will see that basically it's gone. It's through my 83 basis points level there, and now I expect really to get to 98, 99 basis points quite quickly. If we turn this into a weekly chart, you should be able to see how that shows you really that we have nothing until 99 to 100 points. And that this is going to be in sympathy, I reckon, with the refunding in the States. If we look at the French market, you can see how they didn't hold it one day and boom, it went higher. I think this pattern is now unmistakable. This is, basically your cup and handle, and I think that we are going up at least to 26 basis points there. So that is another another 10, 12 basis points. Just like the Bund, it's going to go. There's very little doubt in my mind that the overall overarching pressure in Europe is for higher rates. And basically, you have to be short of everything tactically. When something rallies, and because the ECB is buying it that day, that is the day to short that on an extreme. So I have no reason to change my mind. I think European yields are going well higher, and I think there is a big likelihood that the US bonds join in the party next week. Now, if we have sorry, that's the wrong chart. If we have a look at the spread between the States and the bunds, it's basically dicking around. I don't think it's going to break 174 on the downside anytime. There is a possibility that we go back towards these levels, 189, 190 basis points, but I think then it turns back down. And this is what gives me confidence that it's not just a European thing, it's a worldwide thing, but that Europe will keep pace with the US, at least from these spread levels. The US dollar last week basically just covered a few, they covered a few shorts, but I don't think it's really entering a new bull phase by any stretch of the imagination. I think that a higher refunding, although it might cause the spread between bunds and Europe in general and the United States to come in for a few days, is not bullish for the US. I think, as I've been saying for quite a while, that if the refunding needs are going to be much larger than expected, that is dollar bearish, because people will demand an FX pickup as well to reduce the uncertainty of buying hundreds of billions of US treasuries. To me, nothing happened last week. The resistance and support levels are exactly the same. We're talking about 92.62 to 93.14 on the upside. We're talking very little support at 91.01 and the major support at 88.44. If we translate that into the Euro USD, you can see that basically all it's done is retraced a little bit of what it gained over the prior 3 weeks, and that is normal. But, my major assumption is still that at some stage we attack this 123 to 124 area and that we go higher. It's the situation in Europe is improving hugely in terms of the COVID, the expectations for growth, etc., etc. While the States being ahead, it's already all discounted, I think. And if people demand a pickup on to hold US dollar assets because they're going to have to buy such huge quantities of it, I think eventually the resolution has to be to the upside, 125 to 130 area in the euro. Short term, you're talking about 119, between 119.88 and 119.45 to buy call spreads for the upside. So 119.45 to 119.88 is the first area that you want to start buying call spreads. Also in gold, nothing much has changed, but what I think is very significant is that we are hugging this 1,764.65 level. The market has come back to a very important swing level, and it will respond the way the bond yields respond. If bond yields go up, gold goes down, and vice versa. I think the US dollar is a helping factor, i.e. it's slowing down gold's fall, and that is why so far it has been equities as the best asset class, followed by gold, followed by bonds, because the gold fall relative to bonds has been mitigated by a weaker dollar. So that is why you're getting this this relationship of equities being the best asset class, followed by gold, followed by bonds. I think this will continue to hold for the time being. I think gold is going to outperform bonds simply because of the dampening factor of a weaker dollar. But I still very much see the general direction of gold as the general direction of yields in the US. I am pretty convinced that within 1 month, gold is at least, $50 to $100 different than it is today. If I'm correct, and this refunding announcement turns out to be far worse than the market expects, I am quite convinced that 1658 trades in gold, and very, very quickly. But on the other hand, if it's better, we will go and test the 200-day moving average, which is there 1866. So these levels, you can see them, you can see these lows right here, and these highs. That's the level where we're going to go to, 1850, 1870. Why not? But it's definitely going to be between $50 and $100 different than it is today. So really, straddles in gold might be the thing to buy. On the weekly chart, you can see how now by doing this, what we've been doing, we have opened up the downside, and if the market wants to go down, it can easily go down and test the lower Bollinger, which next week is going to be somewhere around here, 1650. So there you're having it. It's very simple. It's going to go the same way as bond yields. We will watch the refunding announcement on Wednesday, and when we've seen it, a lot of things will be a lot clearer. Commodities are still very much on their way towards this 1841 level that I indicated. I think over the next couple of weeks we will touch it, led by things like copper. Copper had an excellent week again. It just consolidated the last couple of days, but still the move in copper is very much upwards. Of copper against gold, this spread, you can see it's coming down towards the lowest levels it ever saw in 2012 and 2014. And that to me indicates, it's another indication that bond spreads are more likely to, bond yields rather, more likely to move higher than move lower, and gives me some confidence that after the refunding announcement, that it could well be bad that we go quite a bit higher in 10-year yields, at least 10 to 15 basis points. So, nothing has changed there, and that still should keep the pressure on gold. On to equities and what to say about this week, which basically held 41.79.89 all week on a closing basis. It's coiling. This range will break, and my expectations actually are that if the refunding is as bad as I think it will be, the break eventually is on in a downward direction. I just don't think that that we can take much higher bond yields. More so in the highest duration equities, i.e. not SPX but NQ and other high tech sectors. But what we have now, after this week, is we have very good definition. Below 41.79.89, and we go straight down to 4,129, and I mean straight down. And after that, we really don't have much strong support after 4,000, before 4,068. My favored way is down, but I am prepared to trade it to the upside. We know, if it starts breaking higher, it's going to go higher than 42.15 for sure, but it's not what I'm expecting. On a weekly basis, I mean, we've done this little hanging man here. So really, I think that we don't have any definition until we get back down to 39.39. So to me, the weaker side next week, if the refunding is what I expect it to be, and that is the big proviso, if. But we will know everything on Wednesday. There's no need to speculate. We will know on Wednesday. The path of least resistance is going to go down, is going to be down, and I expect it to really trade at least here, which is the break of the Bollingers around the 40.60, 40.80 area. So that's SPX, but SPX is going to be the one that's going to be least affected. The most affected are going to be the sectors, and I will show you what my expectations are now. This is NQ, which has the highest duration, and therefore the one that you'd expect to move the most. Very, very good definition. Look, we've spent something like approximating 3 weeks in this very narrow area between 13,700 and 14,100. This next week will definitely break. And if it breaks down on the downside, if we close below 13,700, or if we're looking at the NDX 13,717, very small difference, I would expect the NDX to come down at least to 3,312, at least. Okay, and that is a move down to these moving averages down here, and these previous highs around 13,323 in the NQ. That's at least, and quite possibly all the way down here to this area of lows around 13,650, and we can have a look at this area 13,786 in the NDX. That is what I'm the minimum kind of moves that I'm looking for. I think next week will be quite violent in NQ. On the other hand, if the refunding is better, if we start breaking above 14,118, we are going well higher. But there is there's no need to speculate. We will know everything on Wednesday, and the sectors like XLK against XLF are the ones that will move most. And here are the sector spreads against the highest duration, which is tech. I really do think that this will move quite substantially next week. XLF over XLK, if we enlarge that, we can see that basically we've been doing a small flag, bull flag, and we could actually start breaking up quite significantly next week. The level is 0.2713. We start closing through that, and we are basically going here. We're going to 30. And that is, that's a 10% move from the, even from the highs. So it's going to get quite exciting in terms of indices. The Dow would be the one that's least affected because it has a lot of financial names in it, and the big tech names are probably not going to be that affected, like Apple and things like that. Is going to be much more the ARC names, which we will look at as well. So I would expect this spread, which is NDX over DJI, to come down and test the 0.3928 level, and that's a big move as well. So you can see that the tech spreads next week, if I'm correct, and I always preface that with the if I'm correct, and the announcement is as bad as I think it will be, these spreads against XLK are going to move a lot. Here we have the Qs against SPY, and it's quite possible that we drop below 0.7972 and go down toward, make completely new lows, and head eventually down to 0.7646. So, that to me is the path of least resistance if the refunding announcement is bad. Of course, the biggest impact is going to be on the highest duration equities, which, Kathy Woods has been so kind to put all into one ETF. This is ARC, and you can see how the retracement of ARC from the bottom, which I nailed at 106.15, is so much less than NQ. NQ is up here, i.e. retraced all of its fall. ARC has retraced absolutely only about 0.382 of the fall. Now this is what you have as the retracement levels right from the low that happened in late March of last year. And you can see that the 0.382 retracement we touched and bounced off. Now we could easily go down to the 0.50 retracement of the 0.618, which is all the way down here, and that actually gives you 100% extension of an ABC kind of move all the way down to here. So you can see that the biggest impact of the refunding announcement is definitely going to be on ARC. EM, nothing really has changed. We actually had a small give up last week, which is disappointing after we managed to break the highs and go up towards 55.83. I guess the COVID pandemic is just too strong in the developing world to get a move now. But I do think that at some stage the market will start discounting an improvement in that situation, and certainly I think that EM to me is better value, especially since I'm expecting a weaker dollar at some stage. So to me this is not a sell. To me this is a market where you buy call spreads or you sell puts. And still the levels are completely unchanged from the ones that I've been giving you all these weeks. they're marked here, and therefore you know what to do. In terms of spreads, what is interesting to me is that against Japan, we actually did better last week in EM. Against Germany, we actually did slightly better. Against Europe in general, we did slightly better. It's only against the States that we started doing slightly worse. But you've seen my expectations for the States, given that if the refunding announcement is as I expected, I would expect this to turn back up towards these levels. So really nothing has changed in terms of EEM or even in terms of DAX and the stocks and the EWJ, i.e. in the Nikkei. If we look at that, that's been weak all the time, and really it's a very good proxy for EM, because EM and the Japanese market tend to trade very much in lockstep at the moment. So really, what am I expecting here? Quite possibly a break below 28,180 and a test of this 26,940 level. I think that's going to be a good buy. So really, I'm looking for that level in Nikkei to start doing some call spreads, 26,940. The VIX should be the big confirmation next week. If I'm correct, we will break 2005. If, I'm not advocating that we break down in the equities. All I'm saying is that will confirm that we are breaking down in equities. I don't know what the refunding announcement is going to be. I just know that it's the crucial thing next week and the thing that gives us the possibility of breaking down. I'm not anticipating anything. I'm just telling you that if it's as bad as I fear it might be, 2005 will be the confirming break that equities are heading lower. And if we do break there, then where are we going? Well, we're going to these levels, 2251 on the weeklies, which is very, very important. And it'll be a question of do we close the week below or above 2251. But I think if we break the 2005, we're definitely going to 2251 that week. So that is the kind of magnitude moves that I'm looking at. If we go back to the daily, here it is. We're looking to these levels, 22, 23, just around the 200-day moving average. But a break of 2005 will signify that we are in that new phase, trading between 20 and 23. Haven't shown you this chart of the Blue Angels for quite a while, and this is why I just couldn't get bearish or cautious even until the earnings of the big tech companies were out, simply because I know what analysts are going to do. As soon as they see one set of earnings, they automatically increase the earnings for next week, and that basically balloons up the Blue Angels. But if the refunding announcement is bad, I would have thought that the equities come back to at least 22, 21 times earnings. And that's a big move from, the 4,200 level. You could easily get a 5% move down towards the 4,000 level. So that is why I think the likelihood, the odds have changed towards a move down in equities as well, if the bonds do what I showed you that I expect them to do on a larger refunding than expected. Onto the summary sheet. I think the levels in 210s, 530s, nothing's changed. Those are going to be the really important levels. And DXY, I've put in the Euro USD, the level that I think is worth looking at to buy some call spreads. Gold, I think it's going to be a $100 reversal from 1765 one way or the other. The first, on the upside, the first is 1810, 1830, but I think it probably, as I showed you, can get to 1850, 1870 if the refunding is much better than expected. On the other hand, I showed you that we are going to go down to the 1650s after, the first break level below 1765. The first support is 1725, but after that we're definitely going down to into the 1650s. SPX, yes, these are all the levels, but NQ is going to be the big mover. Below 13,717, we're going down to 13,300. On the upside, above 14,060, 14,100, it targets a big move. So what I'm saying here is that the refunding announcement is going to be very critical for NQ and all the spreads around NQ. Those are the really important ones. Nothing much has changed in EM. To me, those are still the levels. And the BTPs, the bonds and the spread, everything is confirming. So all the bond yields are going up. And to me, if all the bond yields are going up in Europe, and if the refunding announcement is bad, nothing good can come of it in terms of the moves that you're going to expect from all asset classes, even equities, simply because we are so stretched on a multiple valuation that it's not even funny. We are going to get some give up if the refunding announcement is bad. Now, what to look for? The impact on the TGA. If we have a big drawdown on the TGA, you could easily have a refunding need of around $1 trillion. So the market, if the market has to absorb $1 trillion in net issuance, it's, to me, the path of least resistance is only one, and that is higher in yields. There's no need to speculate, but I'm going to put on some, and I'll show you some very, very cheap trades to put on in the options to take advantage of this possible outcome, and if not, we will know what to do as well. Thank you very much indeed, and tweet you on Monday with all my plays for the Wednesday announcement.